Hello and welcome to Smart Money. Well, 2024 is the biggest election here in history. In fact, it's being called the year of the vote, with people in more than 50 nations, almost half the world's population, expected at the polls. So with politics and markets inextricably intertwined, joining me now to talk impact is Sangeeth Sewnath. He's Deputy Managing Director of the Africa Client Group at 91. Sangeeth, thanks so much for joining us today. And I'm going to cut straight to the chase, right? What does the year of the vote mean for markets?
Alishia, thanks for having me. Yeah, I think we've termed 2024 as a year to focus on the trend lines and not the headlines. The reason for that is that it's quite easy to lose perspective when the world is in flux. And as you say, there's over 70 nations actually that are going through a vote, which is 50% of the world's population. And if anything, with your money, panic will cost you very, very dearly. So we've done the numbers. We've had a look at the analysis of global markets as well as South Africa to try and understand what the implications are in election and presidential terms. And actually, from a global perspective, not much changes. Markets generally go up over time. And so during the election year, actually, markets tend to be slightly more positive than people think they are, because there's a lot of negativity, there's a lot of panic pre the election, and then post-election, actually you get a little bit of a pickup. So contrary to most people's beliefs, it is positive post an election in the short term, and most definitely post an election over the long term. We then did the numbers for South Africa as well. And for the US, we looked since 1926. So we did quite a lot of analysis during the presidential elections. And then we looked at South Africa in a bit of detail. We looked at the last 14 elections in South Africa. At the equity markets and the bond markets, we looked at what do equity markets and bond markets do the year after the election. Equity markets, only 2 negative periods over the last 14 elections. Bond markets, 4 negative periods. But what was interesting is if you go into the second order effects, what you will realize very quickly is that it is not elections in South Africa that actually causes bear markets or troubled markets, really. It's actually global factors like the oil crisis, like the financial crisis, like COVID pandemic.
We're going to get into, the nitty gritty of that in just a bit in terms of what we should be looking out for. But I want to home in on some of that research you did on South African markets specifically, because the research you did going back, to 1966, right? So from the conclusions you've drawn there, where has that now set your bar of expectations as far as these upcoming elections and impact are concerned?
Yeah, look, I think it's easy to get lost in the noise of the South African elections, and given what's going on, the load shedding, the uncertainty in the market, the fact that international markets have a big impact on the South African markets. Our sense is that, again, it's going to be a lot of noise. A lot of people are going to be focused on the headlines and not the trend lines, which is exactly the wrong place to be focused. And it's more likely that a small change in South Africa, a small change will have a hugely positive impact given how negative people are on the country and the expectations. Because it might not be great, but it's probably a little bit better than people think it is. And so our sense, again, from a South African perspective, you've got to look through the noise, you've got to look through the election period, you've got to look at the fundamentals, because markets are fundamentally forward-looking. And it's driven by this need, to predict events and the potential impact of that. And so it always kind of prices in what's likely to happen in the market. So we're a lot more positive just generally around election periods.
Okay, so Sangeeth, going back to then what you were alluding to in terms of the factors that do trigger bear markets, what are you focused on right now, and what are you actually seeing putting the local market under pressure, potentially triggering a bear market?
Yeah, look, we think that, global conditions will affect the bear markets in South Africa, not the local conditions. And so if you do get a surprise on the global scene, and there's a lot of things going on, a lot of South Africans actually think that rand weakness, is the interpretation and evidence that the country is in collapse. But there's a lot of other factors that play into that. It could be simple things like the US are not cutting interest rates as quickly as people think they are. it might very well be a risk-off environment globally where global investors choose not to invest in emerging markets. And so these are factors that affect the currency. People interpret that as negativity for South Africa, which isn't always the case. But if you get a difficult period in global markets, then that will have an impact in South Africa. But, our central case is with interest rates coming down globally, with markets looking a little bit better. So you should get a little bit of tailwinds with interest rates coming down. The trick is whether you're going to get positive growth momentum coming through the markets. And if you get that, you should get a fairly good tailwind for markets globally. And, South Africa's got growth issues just as much as we have high interest rate issues like the rest of the world. Growth is easier for us to see globally than in South Africa.
Yeah, lots of ifs that translate to shoulds, but it's more than likely going to be a very noisy and a very volatile year, right? So let's go to approach. How should we be thinking about navigating through all of this from an investment perspective?
So look, I think there's two things you need to take away from this. Firstly, inflation numbers generally, whether it's South Africa or the world, are a lot lower than what people actually experience. And there's a few reasons for that. Education, healthcare, crime, that means that the inflation you experience is a lot higher than what you actually get reported. And so sitting on the sidelines in money markets, and we're at record highs in terms of household bank deposits in this country. It sits at 1.7 trillion rand. The long-term average is about 500 billion rand. So over 1 trillion rand sitting on the sidelines. And actually, this is not a South African phenomenon. In the US and globally, you've got a lot of people sitting on US dollar money market funds or US dollar bank deposits. Because inflation is higher than people think it is, you cannot make money by sitting on the sidelines. You've got to be invested in the market. That's absolutely critical. And you've got to invest in it for the long term. I think the second one is our sense is that for 2024, like 2023, you will be rewarded for the risk that you take for your investments. So, low equity funds will do better than income funds. High equity funds will do better than low equity funds, and equity funds will do better than all of those three. And so it's a time where you need to take risk to be properly rewarded for that. And we think 2024 is definitely that year. 2023, you saw that in South Africa as well. Income funds gave you around 9%. The funds, some of the funds that we manage, Clyde, Bern, Sumesh and the team, 11% on the low equity. The high equity, the opportunity fund gave you 18%. So you can see the differential in returns and that you were rewarded for it. And we think that's going to continue 2024.
Okay, but it is a big ask, right? To take on risk in a very temperamental environment, if we can call it that. I mean, one assumes you're having to become quite discerning as well in a slowing growth scenario. I mean, how are you seeing slowing growth impacting company earnings specifically? I mean, we had that latest South African GDP number come in at 0.1%, and that I think was even rounded up.
Yeah, I mean, absolutely. I mean, that you've hit the nail on the head. Growth is absolutely critical. And so that means you've got to be very selective about the companies you choose to invest in. And even though, last year, a lot of people saw the run in the Magnificent Seven and it kind of felt like, well, if you just chose an index, you'd be fine. That is not going to be the case. So you've got to be selective. You've got to choose strong balance sheets of companies who can endure the ups and the downs. So even though the downs might not be based on fundamental forward-looking views, you still have to endure those downs as a company. So you've got to have strong balance sheets to do that. And we think that high quality type of investments is really what kind of sees you through this environment, whether that's in South Africa or globally. So you've got to be very selective. You've got to choose strong balance sheets and you've got to choose high quality investments.
And it's exactly this that points us to what you were talking about earlier in terms of turning to the fundamentals, right? So on a fundamental basis, where are you seeing investment opportunities right now in an environment where global and local rates have likely peaked and growth certainly locally slow to no?
Yeah. I mean, look, our best investment idea is global equities. So we think high quality global equity stocks are the place to be. And the reason for that is exactly what we've been saying, which is that's where we find the highest growth at the moment. And so that is most definitely our biggest idea. There's a whole lot of considerations for SA bonds and SA equities, but you've got to see some fundamental shifts there before you get really excited around those investments relative to global equities. So that's still absolutely our most highest conviction view.
Sangeeth, let's leave it there. Thanks so much for having joined us on Smart Money today. Sangeeth Sewnath is Deputy Managing Director of the Africa Client Group at 91.